Welcome to the webinar on pass-through entities, explained and made easy to understand. It's the new section 199 of the IRS code, illustrated and explained by Alan Nathan, CPA, of Nathan Accounting Group. By way of an introduction, our mission is to help everyone unpack complex tax law and other business concepts in a very easy and understandable way. Please tune into this channel for other of our favorite subjects presented in everyday language. My contact information is right on the screen. Please feel free to email me at any time. And I'm interested, and we're interested in what other laws or business concepts do you want us to explain to you. This webinar is animated to take you through the calculations related to the new code section 199 deduction. Here is the presentation in order. The major items to cover are what are specific services, trade, or business, and what is not, and how to calculate the deduction in an everyday situation. The 5 important definitions we'll go through first. Then we'll move on to which businesses are considered specified services, trade, or business, how to calculate the 199A deduction for this type of business, the calculation of 198 deduction for a non-specified service, trade, or business, other notes and comments, and how to learn so much more. Let's move on. Here are 5 important definitions. What is a pass-through entity? That's any trade or business other than a corporation. So it would include any business other than a corporation, including a sole proprietorship, which is a new definition for sole proprietorship is being considered a pass-through entity. S corporation and partnership you would expect. Qualified business income, or what we refer to as QBI. It's generally the income from a business without regard to the salary or guaranteed payments. That is, an owner's salary or guaranteed payment is not considered QBI. Qualified property is a definition that we need to understand, and that's basically the tangible property, the depreciable property of any business, and it's measured at the end of the year. The 4th definition is a phase-in threshold. That is, at 315,000 married filing jointly, the threshold begins. For singles, it's 157,500. We'll learn more about the phase-in threshold. And number 5, phase-in range, and the top of the phase-in threshold, if you will, or the phase-in range. So if you add 100,000 to married filing joint of 315, the top of the range is 415. If for a single, the threshold begins at 157.5, adding 50,000, it will end the range at 207,500. These are important things to understand as we move forward. One of the biggest definitions that we need to understand is what is a specified service, trade, or business. The way the IRS has defined it, it's the fields of health, law, consulting, athletics, financial services, brokerage services, or any trade or business where the principal asset of such a trade or business is reputation of one or more of its employees or owners, or a business in which involves the performance of services that consists of investing, investment and management, trading or dealing in securities, partnership interests, or commodities. What it excludes is the engineering and architecture. Specifically, it was excluded by the IRS. And lastly, I'd like to say that the IRS is due to give us more information in this area, so stay tuned. All right, on to the guts of the materials. Okay, let's start with some heavy lifting. In this slide, what we're going to do here is determine the deduction under 199 capital A for specified service, trade, or business. I think it's important because the way we calculate specified service, trade, or business is different than non-specified service, trade, or business. Start with the question: is the taxable income above the threshold amount of 315,000 for married filing joint or 157,500 for a single? If the answer to that is no, the simple answer is the deduction is 20% of QBI. If the answer is yes, we have to ask ourselves another question. Is taxable income for the taxpayers above the top of the phase-in range, which is 415 for married filing joint and 207 500 for single? If the answer to that is yes, then there is no deduction. Sorry. However, if the answer is no, that means you're in the phase-in range. And if you're in the phase-in range, both A, qualified business income, and the 20% gets reduced by the amount that you're above the threshold amount. Same with the greater of 50% of the wage or 25% of the wage plus property. That will also be reduced by the excess of taxable income above the threshold amount. A quick example of that. Let's run through it. Let's say that you're a single taxpayer with taxable income of $200,000. Let's also say that included in that amount is $100,000 of income from your law firm with an applicable wage of $90,000. That is that the law firm paid its employees $90,000. It's not your wages, it's the wages of its employees. For purposes of figuring the deduction, calculate the applicable percentage. The applicable percentage in this case is 15%. That is, we had 100% of QBI at one point, but because our income of $200,000 is above the threshold of $157,500, that is, it's above the threshold by $42,500. If you divide that by the range of $50,000, that equals 85%. 85% inverted is the 15% or applicable percentage. So once we have the applicable percentage, we apply it to both the QBI and then we apply it to the wages and we take the lesser of the two. So just running through the rest of this example, we take 15% of $100,000, we come up with $15,000, and then we have 15% of 90,000, which is the wage test of the law firm to come up with 13,500. So if we take 20% of the QBI or $15,000, our deduction is $3,000. And we compare that to the wage test, which is 50% of the wages. So 50% of 13,500 are the applicable wages equals $6,750. We, of course, use the lesser of the two amounts, which is $3,000. In this example, it's the $3,000 that we get as a deduction. Now that we've gone through the specified service trader business deduction under 199 capital A, let's look at a business that's not considered a specified services trader business. We start with the same question. Is the taxable income above the threshold amount of $315 for married filing jointly or $157,500 for single? If the answer to that is no, then the deduction is simple to calculate. The deduction simply is 20% of QBI. So below the threshold, 20% of QBI. However, if you're above the threshold and the answer is yes, then you have to ask yourself, are you above the top of the threshold? And if you're above the top of the threshold, then the answer is fairly simple, and that is you get to take the greater of 50% of the wages or 25% of the wages plus 2.5% of the property. If the answer to that is no, that the taxable income is not above the top of the range, that means you are in the phase-out range. And if you're in the phase-in range, then you have to ask yourself, is B, the wages portion, less than the QBI, the qualified business income portion? If the answer to that is no, then the simple answer is you just get 20% of QBI. So if the wage portion is greater than QBI, then you get QBI. If the answer is yes, that the wage portion is less than the QBI, then we start into something called the phase-in range, which is B is less than A. First, we find the difference between A and B from the previous box. Then the excess of taxable income over the threshold divided by the range. We've done that before. multiply 1 with 2, and reduce the 20% of QBI by the results in 3 of above. And that's your deduction. It sounds like numbers and letters. Let's go through an example. I think when we're done with this example, you'll understand it. So example 2. Let's say you and your spouse have joint income reported of $350,000. Your business, which is not specified services business income, was $75,000, and your share of the wages of that business was $20,000. That is, the $20,000 were your share of your employees' wages, and there is no qualified property. So under the formula, A, which is QBI, is 20% of qualified business income, or $15,000. Test B under the formula is 50% of the wages. So in this case, we had $20,000 as wages, 50% of the wages is $10,000. Since we didn't have applicable property, we need to do the test, which is 50% of wages, which is going to yield the greatest amount, which is $10,000. If we stop right there, we could see that since B is less than A, then we need to do an adjustment. And the adjustment works like this. We have to first find out the applicable percentage of income over the threshold. In this case, income was $350,000 and the threshold's $315,000. Therefore, it is over by $35,000. In that it's over the threshold by $35,000. The range is $100,000, and the applicable percentage here is 35%. If we take the $15,000 of QBI, which we found in the example above, we would then take the difference between A, the QBI of $15,000, and B, the wage formula of $10,000 to find a difference of $5,000. That $5,000 times the applicable percentage of 35% is a reduction of $17,500. That is, our deduction under 199A would be $15,000 minus the $1,750 that we found in this calculation for a deduction of $13,250. The closer we get above the threshold and to the top of the range, the closer we will get to only using the test, which is 50% of the wage or 25% of 2.5%. Okay, since we got through the tricky calculations, let's talk about some of the other limitations and a few other comments. First, the 199A pass-through deduction has 2 overall limits. The first limit is 20% of QBI in the aggregate of all businesses. That is, if you have more than one business, all the income and losses would get added together to figure out what 20% of that is. That's one limitation. The second limitation is 20% of taxable income without considering capital gain. So those are 2 big limitations in terms of making this deduction. Secondly, QBI is generally the business income after deducting wages and guaranteed payments. So wages and guaranteed payments are taxed at ordinary income rates and is not eligible for the deduction. 3, the deduction is considered a below the line, i.e. after AGI, so no benefit to our Connecticut friends. Also, this deduction is in addition to the standard or itemized deduction, so it's in addition to probably where exemptions once were. 4, real estate will be treated as non-specified services, but we'll explore this in another webinar. And 5, so much more for the IRS to define for us. Well, if you don't like the weather in New England, wait an hour, as it will change. said by many. Well, with this major tax law, we have waited since 1986, 31 years. Okay, just a little bit about Nathan Accounting Group. First, our mission, providing each client the confidence to make informed financial decisions. Our vision, recognized as a global thought leader emerging from within an engaged and innovative community. Our values are simple: integrity, honesty, world-class client experience, thought leader, and community involvement. Our world-class client experience, together providing a world-class experience for each client every time. And the contact information for our organization. So we're at nagcpa.com, and I'm Alan Nathan. Thank you. Thank you for taking the time today. Please let me know if you have any questions or comments related to this material. And if there is a topic you would like us to cover, or it simply interests you, please let us know. However, we would like to keep our discussions primarily related to tax laws, business management, creating key performance indicators, efficient operations, business transformation, and disrupting an industry. If you are interested, please contact me to do so by email or leaving your topics below. Thank you again.